The problem of profitability in the mainstream auto sector has been a very long one, and that's why we've seen mid to high single digits of earnings valuations for this sector. Is the move to electric for Volkswagen and their peers going to solve their profitability problem?
I think in the long run, it really does, because electric vehicles are simpler. You can manufacture them in a more modular way. You can scale them in a better way. And as the value chain for the batteries is growing and improving, and that's going to take maybe 10 years or so, the industry can become more profitable, less complex. They're more focused in their spending. They're more focused on pricing. So they're fixing a lot of their legacy issues. I think this sector overall is dramatically undervalued. And I agree with Per's comments earlier.
Arndt, what a lovely picture behind you. And I happen to know for a fact that that's a 911 TR, which is possibly yours as well, behind you as well. And is it possible that actually if these companies are split up, they will make a lot more money? I.e., if Porsche and Bugatti and Lamborghini went their own ways as opposed to be part of the larger group, would it be a much better value proposition for our viewers and investors more broadly?
Well, I think that many of these companies have just collected too many assets and put them all together. I think some of these assets were probably saved from extinction, and some of them have really prospered in benefiting from group synergies. But I think there's when we think about this transition and the financial needs to manage that transition, I think there is a legitimate argument to break up some of these huge conglomerates, to allow some of the speedboats to get out and have their own lives, while still benefiting from some synergies, but to lift some of this massive hidden value and to drive the speed of, whether it's electrification, as Herbert says, or, software. Startups can pick up money pretty much for free at the moment, and traditional car makers have to think about how they pick up speed, lift hidden value to be in a leading position to drive this transformation. And that's why I think breaking up some of these assets, breaking them out, is becoming increasingly really important.
Arndt, let's talk about other hidden value as well. I notice in your research note you discuss the value of the China operations and make a suggestion really that maybe that's not really being reflected accurately on the books at this point. As I understand it, 40% of VW sales are now to China, and as you look at the new electric vehicle range, it's very obvious that some of the larger vehicles are being designed specifically with the Chinese market in mind. How do we get to a better understanding of the valuation of those businesses?
A very, very good question. BMW, for instance, has cut a deal to increase their stake in their joint venture partner in China from 50 to 75%. They pay 3.6 billion euros for it. The deal will likely close beginning of next year. And with that, BMW will have full control of their China business, which is a huge step. Daimler is obviously engaged with Geely in China. It also has a big joint venture partner in Beijing. They need to work on ways to get control of their China business. For Volkswagen, it's very difficult because they operate with two government-controlled JVs in China, and they're huge. SAIC and FAW. So there it's a bit more complicated. But Volkswagen is getting 3 to 4 billion euros of dividends from China. They're sending a lot of Porsches and Audis and obviously components into the JVs. It is hugely profitable. I think you can make a point that China accounts for 60 to 70% of cash flows and earnings for the Volkswagen Group. But for them specifically, it's very hard to crystallize that value. It would be easier to IPO 20% of Porsche.